Know the difference with Annex Wealth Management. Tom Parks, Director of Retirement Plan Services, Annex Wealth Management. Welcome back.
Thanks for having me.
If I may paraphrase a classic motion picture line, what would you say you do here?
Oh, that is such a great question. You put me on the spot here, Danny. I better give a good answer. If my team works with employers who offer 401k plans to their employees. We work both with the employer on putting together a really good plan and maintaining it and monitoring it. And then we work with the people who work at that company so that they can take advantage of the benefit. That's the really high level synopsis of what we do here.
So by virtue of that, you are in a bunch of companies. You encounter a lot of questions from a lot of people. Some are simple, some are complex, and some are where you need to maybe undo certain misconceptions from otherwise well-meaning people. How's that? All right. This segment is called Stuff Tom Hears. Where shall we start?
I just recently was with a new client of ours introducing the team, and we were talking about how their plan works, and they do have a Roth option in their 401k. And somebody raised his hand, and I've heard this many times. I'm just using them as an example because it happened recently. And he said, well, the reason I don't want to do Roth is because then I'm contributing less to retirement than I am in the case of pre-tax. And I said, whoa, hold on a second. That is not how that works. So rather than getting into a math, where we're trying to do math here, let me explain just kind of how it works at a high level that makes it easier to understand. When Roth first became a thing, I was a salaried employee and I was doing 10% of my pay to retirement on a pre-tax basis. So I was getting paid the same amount every 2 weeks. And what I did is I switched from pre-tax to Roth. My next paycheck was smaller. And the reason my next paycheck was smaller is because the same amount of money was going into my 401k plan in the Roth versus the pre-tax. That part didn't change. The 10% of my pay was the same amount of money. Say I was making $40,000, right? So $4,000 a year was going in either way. The difference was the amount that came out of my paycheck was bigger in the case of Roth, because now I was paying taxes, whereas before I was not. So it's important for people to understand whether you do pre-tax or Roth in your 401k plan, just like a Roth IRA or a pre-tax IRA, the amount you're contributing is the same. The difference is how much are you paying taxes now.
Stuff Tom hears. Tom is Director of Retirement Plan Services at Annex Wealth Management. You get a lot of questions about investment diversification, and are there misconceptions?
Especially in 401k plans, because most 401k plans these days have target date funds in them. If you look at your 401k lineup and you see all these different investments, and then there's a chunk of them that have all the exact same name, and the only difference is at the end of them, it says 2020, 2025, 2055, 65, all that stuff, right? And those are designed specifically to be one-stop shop investments. And what we see a lot of times is people will pick, because we always tell people don't put all your money in one place, not all your eggs in one basket and all that stuff. So they will grab 2 or 3 of those investments and use them together. And what they don't seem to understand is the underlying investments in that entire suite is identical. The only difference is how is that money allocated? They are already doing the asset allocation and diversification for you. So be careful about that. There is such a thing as over diversification and duplicative diversification, because a lot of times people are buying the same stuff and they don't even know it. They think they're diversified and they're not. So you got to be careful with that one.
Well, we run into that with the portfolio reviews with our incoming clients.
All the time.
There's all sorts of stuff. We're with Tom Parks, Director of Retirement Plan Services, Annex Wealth Management. He and his team work with companies on their benefit plans to attract and retain employees. And Tom, you probably saw the same thing I did. Something like 25% of American workers are planning on making moves as we emerge from the pandemic. Like 34% of millennials are thinking about bolting. So wages are one thing that attract employees, but so are benefits.
Especially with millennials, they're way more in tune to benefits than most people, because they understand that they're paying for pretty much everything along the way. The day of the pension has mostly passed, unless you work for government or a professional sports league or something like that. So yeah, they're really in tune with it. This is really important stuff.
Other things that Tom hears, let's talk a little bit about the difference between contributing to the match limit and then what maxing out is. They're not the same thing.
No, they're not. And Deanna and I have talked about this in our Investigating Myths series. People will always ask our team members, the first thing they ask is, how much do I need to put in to get the company match? Which is a great question. And so let's say you get matched up to 6% of your pay. Well, so you put away 6% so you can get the match. And then people say, see, I'm maxing out. Yeah. It's like, well, hold on a second. The limits are $19,500 or another $6,500 if you're 50 or older, which is a lot of money. And I'm not saying that everyone should put away $26,000 or $19,500. It's just understand that there's a difference between the total match and then the total amount you can put in.
Okay, if a company doesn't match, should you even contribute?
Well, there's another one we hear is, I'm not going to contribute because there's no match. And it's like, well, hold on a second. So you're not going to save for retirement at all? I mean, that doesn't make sense. Usually a 401k plan is a good option because it's easy to do. You decide how much goes right into your pay, into your account before you get a chance to spend it on a 6-pack of beer or another pair of boots or whatever it is. So check out your plan and make sure you're saving somewhere. I mean, if you're not going to save in the 401k plan, that's fine, but then do save somewhere. And wherever else you're going to save isn't going to have a match. So that one I've never really understood.
Let's talk about decision makers. What do you run into with them? I know you've got one all-time favorite, and this is amazing.
Okay. This is my favorite. When we'll be talking to prospective clients and, we'll be talking about understanding fees. And I'm not a fee fearmonger person because the reality is there's generally parity when it comes to fees in our industry and the 401k side. But when I come across someone who says, we're not paying any fees, wow, talk about a red flag. Usually those are the people who are paying the most. And if they're business owners, do you not charge your clients? How would you stay in business?
Right.
Of course you're paying fees. And the fact that you don't know what any of them are is a real problem. You're supposed to know. The DOL requires you to know that stuff and then to make a determination as to whether it's reasonable. And that's what we help them then figure out.
So get competitive when it comes to attracting employees. Have a great benefits program. Get serious when it comes to retaining employees. It's important. Have a great benefits program. That's what you do.
Yeah, and that's where engagement is key. We have a lot of fun with workforces from blue collar to white collar. Our strategy and process, I think, is a lot of fun. We want to be educational and we want to keep people engaged.
Tom Parks, Director of Retirement Plan Services, Annex Wealth Management. Thanks for your time.
Thank you, Danny.